Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Andrew Wallace, one of our Government of Canada traders. This week's episode is titled Waiting for a Catalyst. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Andrew, welcome back. I've brought Andrew on this week because he was in London last week seeing clients. And Andrew, what was the broader theme coming back market-wise? And we can drill in on a few specifics as you go.
Yeah, absolutely. And thanks for having me back on, Ben. I will say, as we've been discussing for the last little bit here, pretty range bound, obviously. Rate vol pretty low, really lack of conviction generally. So we're really digging for, ideas, potential catalysts, Canada specific, global specific, what's going to shake things up and where the next opportunity is going to come. So I think right now, a lot of the discussions around the market and client activity and, our views on the desk are kind of just centered around that. It's like trying to uncover something out there or what's going to be the next opportunity. I'd say when you go and visit clients that are globally active and look at Canada as a slice of their investable universe, there tends to be a lot more questions around Canada generally than maybe we would discuss here when we're front and center, always involved in it naturally. A lot of those discussions obviously around USMCA, what that potentially looks like later this year. We got a kind of reminder of what it could this morning at about 6:45 a.m. as we were just logging on. A lot of questions around the bank always, but those are obviously a lot less right now, just given how they are on pause for this foreseeable future, or at least a couple meetings pretty easily. And then a lot of questions on market dynamics in Canada, trades going through, views on what people are actually thinking, because people don't tend to have much of a view here. So those were kind of the main things. And then, any potential catalysts that drive our market specifically in 2026, which we can get into potentially some of what that looks like in the back half of the year too. So I guess, where do we start out of those factors? USMCA, bank, market, general dynamics.
Start with the bank and go from there. I think that's usually it's a good starting point. It's easy. It's straightforward. Also, the bank is particularly straightforward, so it won't take long.
Yeah, exactly. We can knock this one off pretty quick. So not surprisingly, everyone, really buys into the bank being on hold, kind of two-sided risks, the potential impact on growth and how the economy holds up, given the uncertainty that, overhangs with the trade negotiations. The other side being, potentially what we've seen is the fear of kind of a little real acceleration of inflation, which in Canada we've been able to kind of put in the rear view a little bit recently. So it's kind of that treading that line of when the next move is due to a growth deterioration or, some stubborn inflation or better growth than expected and potentially hikes. So we're kind of going to tread that line. I mean, we're not going to get, I'll let you hit on this, but I don't think we're going to get any really catalyst to drive that one way or the other in the next little bit.
I would be shocked if we get anything in the very near future. It's going to take, Macklem just told us in his speech last week that bad growth isn't necessarily driven by weak demand, and they're not going to necessarily counter it. I think from my perspective, that was a signal that when Q4 stinks, which it will, might be a small positive, which would be better than the flash estimate, but it's still going to be pretty weak. They're not going to counter that. It's fully expected. It's part of the structural changes the economy is currently undergoing. I mean, it's a tough backdrop. Like they don't know what they want to do next. The minutes today said exactly that,
and you can't blame them.
They don't know.
Yeah.
I don't know, you don't know, they don't know.
Yeah, and yeah, exactly. I think what we did get on that this morning, though, as I mentioned, is, the Trump headline, which was nothing new whatsoever, that he wants to withdraw potentially privately from USMCA. There's nothing new in that. And, the market reacted by Canada gapping richer in the futures market. We weren't opening cash yet, but based on implied levels and where futures gapped. We made a pretty significant move richer. And we were kind of sitting on the desk wondering, like, okay, what just came out? And we were like, it couldn't have been that, like, because there was nothing new in that. So the market is still very sensitive in that, and the market will read into any negative Canada-specific outcomes in those negotiations as potentially the first order move is for the bank to step in and support it. Yeah. Now, whether that's a bank thing or just a duration play, but it was a bit of a reminder of about a year ago when we went through this period where these headlines would drive our market richer, headline volatility. So that's probably subsided to a certain extent, or it's become less extreme, I should say, the better way to put it. But it's still going to be there through the year.
Yeah, I mean, in the summary of deliberations, it noted that CUSMA, or USMCA, is a big concern for them. They are watching how this goes. If it goes poorly, they will undoubtedly have to step in.
Yeah.
I don't think it will go poorly at the end of the day. That doesn't change the fact that the headlines are going to be, I don't know, what's the best word? Just to keep it clean. Ridiculous is probably the best one I can use. And I think they need to be faded, personally. Not here, not now, because it's still many months this thing's going to kind of unfold over. But there will be opportunities, and maybe not too far away if we get a continued rally here.
I don't disagree with you for the more immediate term to fade any front-end Bank of Canada meeting gap richening on the back of these headlines. I think that is the prudent way to trade it. I just, near term, I think I would rather skew a little bit towards us pricing it a little bit more. If we are going to get these headlines, the market told us this morning and reminded us this morning that we will price in a dovish bank.
I totally agree. You want to use the rally as an opportunity to sell is all.
Yeah.
That's my bias here rather than getting long, because at some point things will turn. I actually don't think it's anytime soon. And if I had to take a position, it would probably be long here, but I'd rather look for opportunities to fade and use those rallies to establish a core position personally.
Yep.
I mean, USMCA, we more or less covered it with all this, and I'd just like to reiterate, one, unless the U.S. pulls out, which they give 6 months notice for, and then things would look really bad for Canada. But absent that, and by the way, they would pull out of the whole thing, so all Mexico and Canada trade would also be exposed to the USMCA ending, and the U.S. economy would take a hit from that. I mean, Canada and Mexico hit harder, but the U.S. as well. So heading into midterms, that seems like a pretty significant long shot. Like that's would seem wild to me. Anything's possible, but I wouldn't put high odds on that.
Yep.
And if they don't come to a deal, this thing just rolls every year, and you have kind of a 1 year window of negotiations for the next 10 years. And so Canada doesn't have to take a bad deal, which is important. And people forget that like, he can just do what he wants, but like, no, not necessarily. As much pressure as gets put on Canada, we are kind of, the status quo is where we are unless the U.S. wants to pull out.
Right.
So that part's important. I always like to reiterate that. And
now that uncertainty that overhangs as a result is obviously negative.
Yep, very negative. It's
not as bad as a terrible deal.
Exactly.
Yeah.
Well, that's it.
Yeah.
And so you might as well just deal with it and accept the uncertainty, and hopefully
Yep.
in the future you can get something better, or maybe the next administration or whatever it is. But I think at some point Canadian businesses will figure out a way to deal with this and kind of move on. All right, let's move on to market dynamics here. And so what's changed in the Canadian market over the past 3 years or so, I think? Maybe more of the past 2 years.
Yeah.
I've seen more entrants. There's a lot more participation. There's a lot of wider variety of accounts that are in Canada from a variety of places, for that matter. How are other clients dealing with that? What do they see the impact of the kind of change in global behavior in Canada?
Yeah. So a lot of discussion has, as I mentioned, centered around that. And you're right. A big piece is the entrance into our market. And what we're really talking about primarily is the global fast money hedge fund community that have entered the Canadian market. It seems like there's never-ending capital at these funds. They've realized, I think, that Canada has, over the last little while, become a very nice market to trade. Reasons being structural in nature, actually. The liquidity in the Canadian market relative to size, and we hear this from these clients all the time, is very good. Part of the reason for that is there are large provincial programs, large fee-paying issuers in our market that really do, rightfully so, demand and expect really good liquidity, not just in the provincial markets, but in the underlying Canadas, in the swap market. Corporate issuers expect that in the corporate bond market. So it creates really this quite liquid market that is incentivized to be that way when borrowers are borrowing as much as they are. So as a result of that, we've seen new market participants come into Canada, which is kind of, we see it this cycle quite often. What tends to happen is you have a little bit of a washout in Canada, which I think the last major one, you could argue there was a bit of a positioning washout in December, but that wasn't a real one. The last one I think probably you could point to is October 2021. What ends up happening is some of these people that come in and trade Canada end up leaving for a period, and then it kind of builds back up. And that's the cycle we're in right now. We're at kind of a peak of participants in our market. So what does that mean? It suppresses rate vol. Anything that kind of gets out of line, our curve relative to global curves based on data set, gets policed very quickly. Typically, sometimes those are the dealers doing that, but oftentimes it's the client set and this global macro community. So you're seeing more of that. So less volatility via policing. That's particularly taking place in kind of micro RV type structures and trades. The macro big curve volatility has been suppressed, but the RV volatility has been really suppressed. And opportunity set there is much less as a result of that. So you're getting this, because of all these entrants into the market, you're getting volatility suppressed, and everyone's kind of wondering where the opportunities come in a pretty good tradable market because of that. So that's where the questions are centered around now, is like, we like trading Canada, it's liquid, but what's the trade?
Give me an idea.
Yeah, give me an idea. A good example of this is we had a new 10-year bond issued last week. And 10-year bonds typically trade a little bit cheap for the first few auctions just because it's balance sheet intensive and they don't typically perform until later in the cycle. But this 10-year bond came, at the very much the richer end of the historical range where 10 years come, and has traded really well. And we were very, very surprised by the amount of buying of it into and at the auction. And a lot of that was in discussion, was just like, hey, I don't have any other opportunities right now. This is somewhat cheap. I know it's minimal performance, but I have capital and I need to deploy it somehow. This is my trade right now. So that kind of highlights just how grim, I guess, the opportunity set is at times right now in Canada. So we're waiting for a shakeup to create a bit more opportunity.
I mean, that probably begs the question of, when this shakeup comes, some of these guys are going to get absolutely run over if they're reaching on these kinds of trades, and things kind of don't really. I mean, historically, when vol explodes, all these RV trades kind of don't work out so well.
Yeah, no, exactly. And so there's the risk of that. I think a bit of an example of that has happened recently in the provincial market. We saw, a number of these global funds come in and participate in the provincial market, whether it be primary or secondary, over the last, number of months, but in particular came in and looked at provincial spreads and kind of thought, wow, these are getting a little bit tight. There was a bit of a short bias from that community, I'd say, for a period, and then they gapped tighter from there, and stop outs get triggered, and you end up getting, that next move tighter. So you saw a bit of that through the provincial market recently, would be the best example, where some of these trades, where people come in and get a little bit crowded, how they can get a little dangerous. The RV one's a little different, but that's an example of maybe positioning getting skewed and how quickly it can kind of drive a further tightening.
Interesting. I would guess this goes pear-shaped when the bank flips. And
Yeah.
I mean, that's historically what's done it. Pretty much most other times they'll flip when people don't quite expect it yet, and it'll be like, oh no.
Yeah, and it's now it's it goes into some of the structures people are on, carry trades, stuff like that, and when things change drastically, the carry trades can be pretty punitive to have those on, especially when they're the crowded ones.
Yes, I'm with you. Sounds like you don't have a lot of conviction at the moment. Were there any trades that you discussed that you're at least looking at the moment?
Yeah, so one thing I'm considering for, I guess, potentially later this year is, if you want to call it a repatriation into Canadian dollars and Canadian assets from some of our large domestic accounts, pension funds being at the forefront of that. There's been no kind of discussion of this, but just my view on it is the potential of, okay, what happens if Canada becomes a desirable investable universe and they decide to repatriate some investment from other global markets into Canada, that can have a significant impact, obviously, given the size of these funds. My thought on it would be first order move is probably into public markets, bond markets, GOCs, PROVs, etc., which provides a benefit to them. And then kind of second order move is potentially on some of these projects that are being discussed. We don't have a whole lot of detail on that, but if the pension funds find good opportunity in those projects that we're expecting to get more clarity on near term, potentially you see more money invested within Canada versus globally. Now, those funds already participate in the Canadian market pretty heavily on a weighted basis, but the potential of that increasing could have a significant impact on our market.
Yeah, I'm with you. I would probably lean more on the private side than the public side, but the public side could come if and now that I'm thinking about it, I'm pretty bullish Canadian dollar. If they are too, and I would guess that they are, that could bring some money home easily. And if there's no private assets, then you go on the public side. That's what it is. I would hope there are increasing amounts of private assets driven by government, I guess, pushing some of these projects forward, these nation building type projects forward. I'm hopeful we can do something on that front, and that drives a little bit more inflow.
Yep.
I think the first or the easiest thing to look at is the currency on that. Like,
yep.
I think that's the easy trade. If USMCA weren't an issue for us, I figure we'd be through 130 for sure.
Yep.
I think so. We're like 135, 136. I think we'd easily be through 130. So whenever this goes away, I would say by year end we could easily be through 130. I really like the Canadian dollar here, and the way the U.S. dollar behaves and trades just makes me like it even more. I was already kind of on this train anyways, but I like it more now.
So the kicker being, like, as those negotiations are going on, if you're getting this money brought back into Canada for investment purposes, that provides the kicker then further for the Canadian dollar.
Yep.
Yeah.
Exactly.
So yeah, I think that was one of the trades I discussed, or potential events, call it Canada specific. No one seems to be talking about that or considering it, potentially because it's a low probability event or not a meaningful event in the sense that it wouldn't be enough initially and it would be over time, etc. But, that's something I think if we are going to invest in this country generally, and there is an opportunity set from an investment perspective for these funds, that potentially you could see more money in Canadian dollar.
Yeah, I'm with you. I agree. Anything on the rate side? We have a couple things we're looking at, me and Santo.
Yeah, so the only thing I guess I would mention on the back of that would be, potential Canada-US richening, of course, potential PROV spread tightening if it does go into those markets to begin with, before private assets. All of this is pretty hypothetical, of course, but if that were to be how this plays out, then you would see, PROV spreads to potentially trade extremely well. Canada, debt, generally speaking, trade very well. Duration trade really well. Curves generally probably flatten. So those are potential outcomes for the rate market, I think, if that were to play out.
I don't mind that. I think we'll get money coming in anyways. Just a little marginal, as I've said a lot of times, just marginal less appetite for the U.S. dollar. Even if Canada gets a penny or half a penny more than it has, that's a lot of money for us. We're not that big. That'll move everything. All spreads tighter, all rates somewhat lower, I think, and be pretty supportive. So I'm with you on that one. I'm
Santo and you. What are you guys?
So a couple things. There's a CMB Pro trade that'll be in the weekly this week, so I'll leave that one out for today. But I know our swap desk likes this too. But paying 3 or 1 year, I like it kind of closer to 290. It's at 295ish now. I think there's probably still, as you mentioned, there's still more to go there. It might even get through to 290. Could get to 285. Wouldn't shock me entirely. I think paying that, like, the bank has made it clear they don't really want to cut. It's going to be an absolute emergency for them to cut. So rallying materially from here is going to be pretty tough without a cut. And when things turn, they'll probably turn pretty quick.
Yep.
And at sub 3%, that's, I think, pretty conservative way to look at hikes for 3 years from now.
Well, it's a trade you can have on the radar too, as we discussed with these headlines that we're going to get over the next little bit. Like, you potentially get good entry points into those.
So this is the way. So there's two. One, you can be very patient on that, and then maybe you leg both sides of this. And the other side of this trade is one, wait for a nice headline and then sell that pop. And the other leg of the trade would be you kind of want to protect yourself against the tail where things really do blow up, and whether that's like receiving, I don't know, October meeting, which is kind of far out there. It doesn't even really trade, but something like that. You could buy U6 or Z6,
Sure.
Or maybe core options. Just some way to protect the fact that like things could actually blow up, even if the odds are extremely low.
Yep.
In that scenario. So I think that's probably decent risk reward when you do that. Like even if things blow up, unless it's really horrendous, I really don't see 3 or 1 year rallying all that much personally. Whereas like October meeting could go 25 to 50.
Yeah.
And if things go the other way, they're not hiking by October, in my opinion. And if they do, like, man, they're hiking way more than 3 times between now and 2029,
yeah, for sure.
I guess.
Yeah. I don't disagree with that. That's kind of a trade maybe set some around this level if you like the level now, and then just be patient, setting the rest of it. And then when you do get to a certain point, that's where you look to potentially hedge some of the tail risk.
I'm with you. That would be exactly right to me. Yep. Anything else to add?
I don't think so. I mean, it's been, I think probably for most market participants, a bit of a challenging start to the year, whether it be a fiscal year for the banks or the calendar year for funds, in that, we want to see more rate fall than we currently have seen, right?
So we're waiting for a catalyst, and we haven't had one yet.
So I think everyone's kind of in the same boat in that sense. Is like, we're trying to turn over any stone to find opportunities, which we'll continue to do as minor as they might be right now. So yeah, nothing too major. I think you just want to be, as nimble as possible while keeping the lights on, and hopefully, we do have these near-term events that should create some opportunity. And so I guess one other thing to mention is one of the discussions I had with one of the PMs over there who's been in, the rates markets for a long time, was very much like, you don't know when it's going to come, and often it surprises people when it does. So as much as it seems right now like volatility is compressed, it might not be too long before we get a big shake up to that. So, we're hopeful for, something that does return the markets to a bit more of an opportunity set and more volatility. So that's about it.
The reality is, if we knew what was coming, it would already be
we wouldn't be sitting here, buddy.
Well, that's it. And I wouldn't be here anyways. But that's a totally separate issue. But it would be in the market already. We would already have priced it, or we personally, me and you, just wouldn't be here. We'd have our own island somewhere.
Yeah.
So until then, we wait for that catalyst, wait for that shock. Yeah. Don't know what it is, but we'll see. Andrew, thanks for coming on. Appreciate it.
Thanks for having me, Ben.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.